Over the last handful of months, we've gone over several different investing strategies, all with their own strengths and weaknesses. For example, the permanent portfolio was a very tranquil experience. It may not have had the highest long-term returns, but compared to many of the other strategies we've covered, it was a rock. On the opposite end of the spectrum was the all-stock strategy, which can grant great long-term returns, but is also a lot more volatile. Today we're going to be looking at a strategy known as the golden butterfly that seeks to combine those two strengths into one portfolio. But does it actually accomplish this? Is it even possible to have higher returns with less volatility? Let's find out by examining how the golden butterfly has held up historically in terms of long-term returns, volatility, and achieving and maintaining financial independence. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. According to the Golden Butterfly's creator, Tyler, who manages the excellent site PortfolioCharts.com that I've mentioned previously on this channel, this strategy has you split your investments up equally into 5 different categories. 20% of your money goes towards a total stock market index fund, another 20% towards a small cap value fund, 20% goes to short-term treasuries, with another 20% going to long-term treasuries, and the last 20% goes to gold. This does mean that we're going to have to keep one thing in mind as we look back at the history of this strategy. Since 20% of the money is going towards gold, an asset whose price was more or less fixed for around 3 decades, the historical returns before the 1970s are going to be a bit misleading. As a result, throughout this video, we'll be quickly discussing how the strategy has done since 1970 to get a better idea of its track record when all 5 of its investments were free to appreciate or depreciate over time. With that being said, let's start by analyzing the historical returns of this strategy. To analyze the returns, we'll be looking at a few different metrics. We'll look at the long-term 40-year inflation-adjusted returns for every year starting from 1927 through the end of 2019, since that's still the first and last year for which I have complete data on all the assets involved in this strategy at the time of this recording. We'll also be taking a look at how many times the portfolio lost money and how severe those losses were. Finally, we'll touch on how dependable or trustworthy the returns this strategy has generated have been by examining how sensitive those long-term returns are to when you decide to start investing. So based on the data I have, since 1927, the average 40-year inflation-adjusted return for the golden butterfly is about 5.1% per year. Its worst-case return was about 3.3% per year, assuming you began investing in 1936 or 1937. Its best-case scenario was an average return of around 6.7% per year, assuming you began investing in 1975. That suggests that a $10,000 investment would grow to, on average, around $73,100 over the course of 40 years, after adjusting for inflation. At worst, you're looking at a nest egg of around $36,600, and at best, $133,800. Now obviously we have to take these figures with a grain of salt due to the gold issue that I mentioned earlier. Since 1970, the golden butterfly has trailed the all-stock strategy in terms of long-term returns, with an average of 6.2% per year compared to the all-stock strategy's 6.6% during that same time. But all things considered, that's not a huge gap. Especially when we get to later parts of this analysis, it's possibly a worthwhile trade-off for many investors who would otherwise have looked at the all-stock strategy as their top portfolio of choice. Now, let's take a look at some of the volatility metrics. The average standard deviation of returns for the golden butterfly was 10% since 1927, which means that in any given year, we can expect that most of our returns will fall somewhere between negative 4.9% and 15.1% per year with this strategy. The standard deviation since 1970 was even lower, at 8.9%, placing it just behind the permanent portfolio's 8.7% during that same stretch of time. And just like with any of these strategies, there will occasionally be a few exceptions where the returns fall outside of our expected range, for better or worse. Looking at the individual returns for each year in our return diversity chart, we see that roughly 70% of our returns fall within our expected range since 1927. So that's pretty good. There were a total of 24 years out of a possible 93 where the portfolio failed to keep pace with inflation in this sample. That's a loss frequency of about 26%. Thankfully though, most of those down years stayed under 10%, and not a single one crossed 20%. So while it did fail to keep pace with inflation slightly more often than the permanent portfolio, at least since 1927, it was significantly more tranquil than something like the all-stock strategy. Since 1970, the golden butterfly has failed to keep pace with inflation 10 times for a loss frequency of 20%. Thankfully, the majority of those down years, as few of them as there were in recent memory, were recovered from reasonably quickly, as there was only only a single 10-year stretch where the strategy failed to keep pace with inflation. That was between 1939 and 1949, where it trailed inflation by roughly 0.5% per year on average. Now, of course, had gold's price not been fixed at the time, we may have had a different story. But given that gold's price was fixed, we don't know for sure. Beyond the 10-year rolling returns, the golden butterfly has also showed remarkable consistency year to year. Not just because the majority of the returns fell within the handful of percentage points of its average, but because it rarely failed to keep pace with inflation more than 1 year in a row. In fact, since the 1950s, this has only ever happened once, from 1981 to 1982, and both of those drops were due to inflation, which was pretty high at the time. The nominal returns of the portfolio were actually positive in both of those years. Next, let's talk about start date sensitivity. Start date sensitivity, at least as we measure it in this series, takes a look at the rolling returns of the 10 years prior to each initial investment date and compares it to the rolling returns of the following 10 years to see how big of a difference there is between the two. It's a good way to get an idea of how dependable or trustworthy an investment strategy has been historically. And ideally, we want to keep our total start date sensitivity, measured by the difference of the largest underperforming decade and the largest overperforming decade, as low as possible. The golden butterfly has a total start date sensitivity of 16.8% during this time frame. The largest overperformance was 7.5%, which took place from 1949 to 1959. In those years, the golden butterfly strategy had an average inflation-adjusted return of 7% per year, beating out the returns from 39 to 49 of negative 0.5% per year. The largest underperformance was negative 9.3% when the returns from 1937 to 47 failed to match those returns produced from 1927 to 1937. Of course, again, those figures all come from a time when the price of gold was mostly fixed, so since 1970, the start date sensitivity looks a lot better. The total start date sensitivity since 1970 clocks in at just 6.1%, with the largest overperformance and underperformance each hovering around 3%. This puts the golden butterfly again at the top of the list in this metric, even beating out the permanent portfolio, which had a total start date sensitivity since 1970 of 6.7%. So what we're seeing here is a portfolio that has solid returns over the long haul, trailing basically just the all-stock strategy among the ones we've covered so far in that category since 1970, while staying pretty darn consistent and rarely failing to keep pace with inflation for more than a year at any given time. And even when it does fail to keep pace with inflation, it's usually not falling behind by too much. All of this remains true pretty much regardless of when you decide to start investing. And that's pretty impressive if you ask me. But that just about wraps up the analysis of this strategy's returns. Now let's move on to our crash analysis. A crash analysis is important to do for any investing strategy you're looking at because it's important to know that if you're going to put your life savings into something, that you'll be able to weather the storms when they come, financially and otherwise. In these videos, we look at a few different metrics when analyzing the crashes. They are how deep the crash got at its worst, how quickly the strategy typically recovered from said crashes to reach new highs, and the Ulcer Index, which largely combines the other two metrics into a single number. The deepest and longest crash for the golden butterfly came shortly after World War II. After setting all-time highs in 1946, it would fall as much as 26% over the next 3 years. Again, worth noting that inflation rose by almost 32% during those 3 years. So the strategy still grew in nominal terms. It would set a new all-time high by 1955. So the crash lasted about 8 years. However, since 1970, the crashes were both much more mild and much quicker to recover. The deepest and longest crash during the last 50 years for the golden butterfly took place from 1970 to 1973. During the crash, the portfolio fell by as much as 14.6% from the all-time highs that were set in 1969, before setting those new highs in 1973. As far as the crashes since 2000 go, the results were pretty staggering, at least based on how the data is set up for the spreadsheet I'm using for this series, which looks at the value of the portfolio once a year, generally in January. The dot-com crash didn't even register, since the portfolio set new all-time highs in every year of the 2000s except for 2009. In 2009, it fell around 7% from the highs that were set in January of 2008, and by 2010, it was back to setting new all-time highs again. The Ulcer Index during this time rose to as high as 1.5 during the early 1950s, and on average it hovered around 0.4% since 1927 and 0.1% if we're just looking back to 1970. With that being said, let's move on to examining the strategy in regards to financial independence. Historically speaking, the golden butterfly would have maintained a minimum safe withdrawal rate of 4.04% over any 30-year stretch, 3.55% over any 40-year stretch, and 3.34% over any 50-year stretch since 1927. The worst year to retire using this strategy was 1937, as that's when all of these minimums were set. I should note that, as usual, due to the varying nature of individual expense ratios and tax situations, neither has been considered in these withdrawal rates. The median rates were 6.07%, 5.27%, and 4.92% for the 30, 40, and 50-year scenarios, respectively. And the maximum rates for the same durations were 7.82%, 7.28%, and 5.98%. The strategy would have maintained a minimum perpetual withdrawal rate of 3.09%, and as usual for this series, I'm defining perpetual withdrawal rate as the highest withdrawal rate that you could have had while still maintaining your original principal all the way through to the end of the dataset after adjusting for inflation. So if you had a $1 million nest egg when you settled down in 1927, that perpetual withdrawal rate would still leave you with at least $1 million worth of buying power by January 1st, 2020. Hopefully that makes sense. The accumulation phase of financial independence is where you're still putting money away for your future. The primary metrics here is what percentage of our income are we saving, how do our expenses change over time, how long do we plan to be retired, and how long will it take us to reach financial independence based on that information and the performance of our investing strategy. Assuming you planned on a 30-year retirement and your expenses changed in line with inflation as measured by the CPI, with a 15% savings rate, a hypothetical investor would have reached financial independence in 3 of the 93 scenarios. On average, achieving FI with this strategy and at this level of savings took about 90 years. The fastest was 88 years starting in 1927, and the slowest was 91 years starting in 1929. With a 30% savings rate, a hypothetical investor would have reached financial independence in 34 of the 93 scenarios, on average taking about 65 years to do so. The fastest was 39 years, again starting in 1927, and the slowest was 78 years, this time starting in 1933. With a 50% savings rate, a hypothetical investor would have reached financial independence in 74 of the 93 scenarios. On average, achieving FI with this strategy and at this level of savings took about 28 years. The fastest was just 12 years, starting again in 1927, and the slowest was 41 years, starting in 1946. And finally, with an absolutely crazy 70% savings rate, the numbers improve even further, with a hypothetical investor reaching financial independence in 85 of the 93 scenarios. On average, achieving FI with this strategy and at this level of savings took about 11 years. The fastest was just 5 years, starting in 1929, and the slowest was 20 years, starting in 1966. So in the end, does the golden butterfly strategy accomplish its goals? Well, historically speaking, yeah. Its average and median return figures, especially since 1970, appear to be in the same general ballpark as our all-stock strategy, and the volatility metrics paint it in a much more appealing light than something like the S&P 500, and in some cases even better than the remarkably tranquil permanent portfolio. However, no strategy is perfect, and as great as the golden butterfly has been historically, and as much as I like it personally, it does have some potential drawbacks to keep in mind. Mainly that it isn't too well diversified outside of the US market. That obviously hasn't been a major issue in the past 90-some years, and it may not end up being an issue in the next 90 or so years, we don't really know, but with 80% of the money being divvied up between US stocks and bonds, it is worth at least keeping in mind. But what do you think? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.